Good morning and welcome to the IQGEO Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Richard Petty, CEO. Good morning to you, sir.
Thank you very much, and good morning and welcome everyone. My name is Richard Petty. I'm the CEO of IQGEO. I joined in 2016. And we've got a deck today that will give you an introduction to our company, the markets we serve, our product, and of course our financial results.
Good morning, evening or afternoon, everyone, depending on where you're dialing in from. I'm Hayward Chapman. I'm the CFO for IQGEO, and I joined in September 2020.
So by way of introduction, IQGEO is a software company. We provide software to two markets, which is the telecommunications market and utilities market, so water, gas, electricity. And our big idea was providing a software solution that allowed telco and utility operators to plan, build, and operate their networks in a single solution. So we're all about building better networks, and we're all about helping network operators generate faster time to revenue in terms of new network builds, or to just improving the quality and the safety of their networks.
So as of today, we've got about 450 telco and utility customers in over 40 countries worldwide. There are over 80,000 users using our system. These are fairly mission critical systems. They're very important to our customers. And we think that the longevity of these systems will be for the lifespan of the systems that they're supporting, whether that's fiber that's going in or whether it's an electricity distribution network. We have over 280 staff and directly employed contractors in our offices around the world. Our largest office is in Denver, in Colorado. We are headquartered in Cambridge, in the UK. And then the Comsoft acquisition has recently bought us the Ghent office, where we've got about 50 staff, and also an office in Toronto in Canada. We also have smaller offices in Frankfurt, Germany, and in Tokyo, Japan, where we run our Asian operations from. Our main go-to-market model is a subscription model, and I'll come on to that later on. We sell our product direct and through channel, mainly depending on the geography. So in Asia, it's mainly a channel play through partners like NEC and NESIC. In the US, it tends to be a very much more direct sales model through our own sales team. And in Europe, we've got a bit of a mix. We've got a direct sales team, but we've also got a number of partners, and we're seeing a number of bids coming in from Africa and Asia, again, mainly through a partner network. We can deploy the product in the cloud or on premise. We can deploy it through AWS and Azure, or we do a private hosted cloud, and also on premise. And the product is by its nature mobile first. So it's been developed from the ground up as a mobile product, so users can use it in the field or in the back office.
So I mentioned earlier that we provide a single solution to plan, build, and operate networks. And our vision has been to create a software solution that can handle or that can support the entire network lifecycle. So the network lifecycle is all of those activities that takes a network from the drawing board to being a live revenue-generating asset that's summarized here: planning, design, construction, operations, maintenance, and then through to customer service. Now, the importance of our positioning and this all-in-one positioning is that today most of our target market handles the network lifecycle with kind of a best-of-breed approach, where they themselves are buying solutions into each one of these areas here, and then are left with the problem of having to integrate them themselves. So right off the bat, that's creating integration risk between these solutions. But more importantly, it creates a deficit of information because each of these solutions kind of come with their own databases, and that creates silos. It means information is fragmented across the enterprise. It means that it doesn't travel easily across the enterprise. And all of that results in a lack of visibility of network asset data in particular. It means that different departments can't see what's going on the network. They can't see the network assets. And all of that results in severely interrupted workflows and therefore a lot of workarounds. So by providing our customers with, first of all, a system of record that contains up-to-date asset records that are presented in the form of a digital twin of the network. So the first thing you do is make sure that everybody has access to the same data. And then with our solution, we allow each department to then automate and digitize their department-specific function. All of that in turn enables the construction of much more robust workflows across the enterprise, all of which results in improvements in productivity and improvements in quality. So all of that is underpinned by some very, very strong architecture. And we say two things about our architecture. First of all, that we're cloud first. So the product was always designed to be a cloud solution. So it's not been designed in some other architecture and then ported to the cloud. And this matters in our market because most of our competition and most of the incumbent vendors in this market have older solutions, client-server style solutions designed in the 80s and 90s that are not optimized for cloud consumption. Frequently, they are fat client and sorely lack mobile capabilities, and therefore they don't scale well and are not solutions that enable, I would say, agility throughout the enterprise. The second thing we say about our solution is it is mobile first. And what that means is that our mobile capabilities are baked into the core product. And again, this is to differentiate ourselves from our competitors. For our competitors, our major competitors, mobility is a plug-on and is a separate system. And so immediately you're into problems of having separate databases, interfaces between products, data connectivity issues, reconciliation issues, and also productivity issues, because moving data between two systems is never the best way of getting things out into a mobile user. So mobile first, cloud first, and this whole picture together, creates a very compelling solution for our customers, which has resulted in a significant growth in orders. I will at this point say that this is we don't aim to sell this entire solution at the same time. Typically, we will start in one area. So in the fiber market, planning, design, system of record, and construction has been extremely important in the last few years as operators look to upgrade or grow their networks. But even in markets, and so therefore that's a good starting point. But as Hayward mentioned, we aim to create very long-term relationships with our customers. 10, 20 years is typical, and those are the kind of relationships we're replacing. And therefore, this kind of a solution, modular solution like this, creates many opportunities to upsell and grow our software presence with our customers. And therefore, we talk about landing and expanding. So in recent years, our mission has been to get into these accounts quickly, which is why we talk about new logo accounts, because that is effectively the start of a relationship that we expect to grow over years. So this might be a good opportunity to talk about. There's a couple of questions coming in, which is great. Keep them coming. So first question is, what portion of recurring revenues from telcos versus utilities? I'll let Hayward answer that in more detail, but right off the bat, it's about 60-40, roughly speaking, 60 in favor of telcos. We do well with utilities. Japan is heavily dominated by utilities. We've signed some very significant orders in Europe recently as well. But I'd say right now there has been a rush to upgrade fiber networks. So we're seeing a lot of telco come through in the last couple of years, and in our 23 figures. I think the further out we look into the future, the utilities market is larger. There's more players. It's less consolidated, and so we will see utilities be a more important part of our revenue mix.
Yeah, I agree with that, Richard. Yes, I think it's slightly in the favour of telcos at the moment. I think especially with the Comsoft coming on board, we've seen a swing in that direction, especially in the near term. But as Richard said, in the long term, we see a big market on the utility side as well. The second question there regarding recurring revenue, near-term targets and margins, I will answer as we go through the deck. Okay, so just in terms of our target industries, on the right here, you can see the what we would call the original IQGEO enterprise network, the enterprise product, and that is aimed at the telco networks, the electrical networks, and then in the very simplest format, the gas and water networks as well. We've done 2 acquisitions over the last 2 years. So on the left, you will see OSP Insight or OSPI, which now forms our SMB, small and medium business unit, and that is aimed purely at fibre companies and fibre network design and operations. And we sell to a wide range of industries there. The ticket size on this product is generally between sort of $10,000 and $40,000 a year, sold on an annual rolling contract. We sell it to municipalities, government bureaus, large corporates, transportation, for example, Florida Transport Highways is a customer of ours, university campuses, so education. And then we have got a couple of mining customers in Australia who have their own fibre networks in the mine and use the product to map that fibre network. The second acquisition we did in August of 2022 was Comsoft, so that has its own automated network planning and design software. Mainly used at the moment for fibre networks, but it's also got the capacity to sort of automate planning for electrical networks. And then also there's a small part of the business that is aimed at district heating. So not a huge thing here in the UK, but certainly in continental Europe and in the US. They've got these sort of large district heating networks that run under cities and sort of pipe water around, and it's got a module that caters for that as well. So there's really quite a wide range of industries that we can use the software for. Okay, so over the next few slides, I'm just going to highlight some of the key financial results for our year ended December 2022. Our revenue was up by 92% at top line level to £26.6 million. Of that increase, 57% was organic, which was an increase on both 2020 and 2021 when the organic rate increase was 18%. Our gross profit increased by 78% to £15.7 million. And there was a slight decrease in the margin from 64% to 59%. And that's purely as a result of the change in the sales mix. Our services side of the business did very, very well. As we're implementing a large number of large projects, and to get through the work, we had to use external third-party consultants who are slightly more expensive than our own internal staff, and hence the margins on the services side decreased from about 27% in 2021 to about 20% in 2022. We hope to see a recovery in the margins on services, and therefore probably at a group level as we move into 2023. And then it was our first year, quite an important milestone, our first year of an adjusted EBITDA positive figure, which was £1.9 million compared to a £0.8 million loss in 2021. And then sort of just the last bullet point there on that slide, our operating loss, or right at the bottom line, was a £1.5 million loss compared to £2.6 million in 2021. But if we strip out any non-recurring sort of exceptional items associated with acquisitions and integration, it was a £0.5 million loss in 2022 versus in 2021 a £3.1 million loss, where we had an exceptional credit coming through the P&L. So that gives you a really good view, I think, of the trajectory of the bottom line of the business. Obviously, we focus on subscription revenues and recurring revenue. And you can see there that our exit ARR, so that's our recurring revenue on an annualized run rate based on our December year end, had increased by 84% to £15.1 million. And another increase of 84% was the amount of in-year recurring revenue, which increased to £10.6 million. In terms of our recurring revenue order intake, so that's the annual recurring revenue multiplied by the number of years of the contract we've signed. That was up by 114% to £22 million. We signed a number of 3-year and 5-year contracts during the period, which was really nice. And then our net cash at the end of December was £8.1 million, down from the end of 2021. But of course, we've got the acquisition of Comsoft going through, and also the slight £3.5 million inflow from the fundraise that we did associated with that acquisition. Just a few more KPIs. So our own product orders of our own software, we do a little sort of third-party services line, which we're excluding from this figure, but that was up by 115% to £40.5 million. And our recurring revenue net retention, so that's the amount that we measure it from the start of the year to the end of the year. So that's the amount that our customers have grown through either pricing, revenues from our customers have grown through either price increases or new module sales or increasing number of seats taken, was 108%. We won 64 new logos in the year, and of that, 43 were from the SMB division. So that's the OSP Insight acquisition that we did, and the smaller end, tier 3, tier 4 end of the market. And we did 21 new enterprise logos. So, similar numbers to 2021. And as Richard said earlier, that logo count is important because it enables us to sort of, our strategy is one of land and expand, and we've got a really great platform there to expand those accounts in the future with a good, recurring revenue net retention. Our employee headcount increased by 76% to 180, and that includes the 47 colleagues who joined us from Comsoft. And then we did a net 31 employee hires across all geographies and all disciplines within the business during 2022. So I ended up with 180 employees at the end of the year. Okay, I will just, I think I've covered most of these points here on the income statement summary. I've talked about the revenue, the gross profit, which is up by 78%, although the margin fell slightly. We expect that to recover. And then the adjusted EBITDA. So hopefully I've covered all those points. Please ask any questions if you've got any more, but I'll hand over to Richard.
Yeah, Hayward, just before we move on, a couple of questions. Did you answer the question on recurring on margins and why they did?
I hope I answered the question on margin. Right. I think I've covered off why that dipped slightly.
And then there's a new one come in, which I think is a good point here. How much did order intake grow organically in 22?
Yeah, so that would have grown organically by about, I think we did 114% growth. Let me just go back. I think it was, I haven't got the exact figure. I'll have a look at that, and while you're talking, I'll come back on that question because I haven't got it quite to hand.
Okay.
But I'll come back on that one.
Great. So I'll just advance here. Right. So Hayward mentioned we picked up over 60 customers last year. So we've got a few here that kind of tells the story of what we're achieving globally. So probably the most important new customer we picked up in 22 is AT&T. AT&T are the largest telco in the world. And I think what we're doing there is we're helping them with their new strategy, which is to double down on communications. They're moving away from entertainment. And communications in this context is really about their fiber broadband offering. So AT&T are one of the big copper franchise operators in North America, and their CEO has set a strategy to provide a high quality fiber product to their captive audience, and in addition to that, to grow their fiber penetration into non-franchise area and to pick up new market share that way. So we're working very closely with AT&T. We are helping them completely transform the way they design and manage the construction process for fiber. They're looking to make themselves much more agile and to move faster in the market and so all of that's being underpinned by our technology. Of course, AT&T is a fantastic logo. It generates great awareness for us in the US market, and it drives a lot of inquiries our way. In the same vein, Consolidated is another large copper operator in North America, which we've picked up last year. So they operate in about 20-something states, and again, looking to move their copper customers to fiber. So we're working closely there. Lightpath is an interesting logo. They are a spin-off from Altice. So Altice is one of the great cable and broadband operators in the world. They're French. They bought assets in North America, which they rebranded Altice. And last year, they decided to spin off their B2B business into a separate vehicle. And they sold 49% of that company to Morgan Stanley, and obviously looking to lock into their business customers and offer them an upgraded fiber solution. So very, very important win for us there. And again, we're at the heart of their business transformation. Moving to utilities, I'll pick out Stedin, which is one of the 7 electricity and gas operators in the Netherlands. They have about a 25% market share. Stedin, along with a number of countries in Europe, is responding to the European legislation around decarbonizing industry. So there's a program of legislation which is broadly termed Fit 55, which involves emissions, car emissions, or moving away from internal combustion engines. You've seen headlines in that recently. Things like construction standards, building installation standards, and so on, and also around decarbonizing the grid. So Stedin have been raising funds in the market through bond issues to add a lot of solar and wind power and to extend the scope of their grid. There they've required an enterprise-wide mobile solution to help them manage the workload and, of course, maintain and operate their grid. So we're a very strong endorsement for our product and a big account for us, and by revenue one of the biggest in Europe. Okinawa Electric Power continues the success we've had in Japan. So in Japan we work closely with our partner there, NEC. And NEC have helped us introduce a product to the Japanese market specifically aimed at utilities operators to help them manage their efforts during emergencies. So it's an emergency response system. So again, based on our strong mobile capabilities. And there we've done very well working with NEC. We've picked up the top 4 utilities. There's 10 electricity companies in Japan. We've picked up the top 4 already, with some very substantial accounts there, thousands of users. And Okinawa continues in that trend. They're on the smaller end of the operators, but again continues track record of success there. And then on the lower line, I'll just pick out Arteria, which is our first telco customer in Japan. They're a private networks operator, operating particularly in the large metropolitan areas, Tokyo and cities like that. But it demonstrates that our telecom solution is viable and interesting for our Japanese customers as well. And then I'll pick out Unite. Unite was a win for our SMB business that Hayward mentioned earlier, and a wonderful example of the kind of solutions we do there. They provide private networks for education, so high schools, universities, and also some healthcare. And their claim to fame is that they provide networks for over 2 million. They provide fiber networks and mobile networks for over 2 million students across the US. So very nice example of the kind of customer we're picking up with our SMB product.
Okay, a couple of questions just there. Could you share how much your order intake and backlog grew organically? So the answer there, it's about 80%. Obviously, some of those new orders coming in the year were from the Comsoft acquisition, but in terms of if we strip that out, it'd be about 80% organic growth on the order intake. What is your gross customer retention? It really depends on whether it's the SMB side of the business, which is the smaller customers that tend to have a slightly higher level of churn, or the enterprise business. On the SMB side, we started the year with 242 logos. We gained 43. There was churn of 11, ended up with 274. On the enterprise side, those churn levels tend to be a lot lower. I think there were 5 customers who left, and we gained 21, ending up with about 183 enterprise logos at the end of the year. So I think was the net retention. I think the question on the bolt-on and acquisitions maybe we'll cover at the end.
We'll cover that later.
Presentation, Richard.
I will point out that on the SMB product line, quite often that product gets picked up for project purposes. So often engineering firms will take a year-long license to design and build a network, and then when the network's being handed over to their customer, the software gets turned off. So there is a certain amount of attrition, which is normal in that customer base. Okay. Great. So here's a section where we'll give you an update on our market and our products. So we've posted some very good results for the last few years, and often investors ask or wonder, for how long this growth rate can continue. We are benefiting from the surge in investment in fiber and 5G worldwide, and we feel we're at the beginning, still at the beginning of the market. And in fact, there's some data here showing that really there's a lot of headroom left in the global fiber rollout. So data here from various associations, and you can see that Europe, North America, South America, Middle East, and so on, we are still at sub 25% market penetration. And what we know is that markets will continue rolling out fiber until they get to 80, high 90s levels of penetration. So if you look at markets like Korea and Japan, where there's very high levels of fiber to the home penetration, they're at 80, 90%. So we see a very significant amount of growth yet to come on the telco market, and this is what's underpinning our confidence in our story. In addition to private money being pumped into fiber networks in the US, there's a lot of federal money being made available. The Biden administration there, has identified availability of broadband as being very closely linked to economic development and mobility and well-being. And this money is being made available particularly for rollout of broadband to rural areas. Our customers are participating in a lot of federally funded projects for these expansions, and of course, all of that is driving expansion for us as well. So we offer a specific set of solutions for each of our verticals. So the one I showed you earlier is more of a sort of a telecom version of what we do. And here we talk to our customers about accelerating time to revenue. So these are the key drivers for them. And so being able to reduce the time it takes to design and build a network, and reduce the time it takes to connect a customer, or reduce the time it takes to restore a customer. These things translate, immediately to revenue. And so, we've got proven capabilities and our ability to, reduce costs and accelerate time speeds in these areas. And these are typically validated in workshop environments and in pilot solutions. And so, often our solution is wrapped into a business case that then gets sent up to management for approval with very strong KPIs associated. And this also accelerates what we do. I think this might be a good point to answer the question on acquisitions. So yes, we have made acquisitions into this workflow for telco. We have quite strong ideas about what we can do in-house and what we can't do in-house. So the Comsoft acquisition was a result of that thought process. Automated design and build is very specific. It's very sort of algorithm-heavy type work. And we saw a demand for that. And so it made a lot of sense to go and buy that sort of thing in the market. And as it happens, we were able to buy the market leader, which has been a great feather in our caps. So there are other areas we will look at for acquisition purposes. And we do feel that acquisitions will continue to be part of the growth story. The way we've positioned ourselves does make for quite a broad church from a product perspective. and therefore, this gives us opportunities to look to incorporate new technology or to acquire older technology and absorb those customers and migrate them to our technology. Now, one thing which we want to draw attention to is the opportunity on the utility side. So in the last couple of years, our story has been quite telco heavy because it's getting so much press and we're doing well there. But in many ways, the utilities market opportunity is bigger. There are more players out there. We value the market as being worth around $1 billion in recurring revenues a year, which is about 5 times bigger than the value of the telco market. It is slow moving in some ways. The planning cycles there are longer, but nevertheless, the opportunity is significant. So there's a piece of research here specifically around software technology for grid operators, and we can see here that this particular firm, the Indigo Advisory Group, value the market at around $600 million in 2020, growing at very healthy rates. In addition to that, we're seeing, again in the US, we're seeing federal money being available to modernize grids, and that takes the form of grid resilience and reinforcement, and also decarbonization. So again, what we are seeing and what we're planning to sell into is a very large capex program to upgrade grids and migrate to smart grids in all our main markets. So here is the oh, sorry, I think I've advanced too fast. So here is the solution we offer to these customers. It looks different to the telco one, in particular the outage response, inspection and survey at the end is a critical component for our utilities customers. And here, it's important that we don't just, provide them with a facsimile of our telco solution, but actually a built-for-purpose utilities product that responds to their view of, what the network's lifecycle looked like. And here we talk about enabling grid modernization. So the adaptive grid product line here is all about helping these network operators move from the current state of their grid to the future state of their grid, and this is a combination of changes to their build cycles and operate cycles. Question on customization, which I can take straight away. The product is shipped as standard, so there's one core code line that is shipped to products. There is then some modules according to the market we sell to and according to the department or the area they're trying to customize. But inevitably, particularly on our large enterprise group, there is configuration that needs doing and occasionally customization. These are projects that can take 3, 6, 9, 12 months to complete. Hence the surge in professional services that you see in our numbers. And we have to work very closely with our customers and helping them understand their requirements, understand what best practice is in the market, and then rolling out the solution in a way that ensures that the business needs are being met, that we're getting the correct level of adoption and user acceptance. So very challenging projects, and with the end result being a solution that is made to measure for our customers from a standardized core product. Less so in our OSPI product range. This is our entry-level product, which is designed to contain best practice in it, and so that product requires almost no customization, and in fact it installs very, very quickly. So a typical OSPI product customer will be up and running in just a few days, and we help them with that. We help them migrate the data, and it's all about making the product easy to use and easy to consume and fast to consume. So we adapt our product lines to the type of customer we're selling to. Enterprise customers inevitably need more customization, and the smaller ones are all about speed of adoption, and so there's almost no customization. To stay with the theme of grid modernization, grid operators worldwide are facing really quite a substantial range of pressures and changes to their business model. So on the left, I list some of them: decarbonization, the arrival of prosumers, so consumers that produce energy through solar or wind. In many of the markets we serve, very, very serious changes to weather patterns affecting grids, floods, storms, earthquakes even. Of course, the arrival of electric transport and cars putting pressure on the grid, and of course regulatory pressure. So really quite dramatic changes to these operators. And of course, they are, being older organizations, very often they have data problems and challenges with their existing architecture. So all of this is putting pressure on these operators. And I think in the last couple of years, there is a swell of pressure on them to start to modernize their grid. Now, modernization, looks different in different parts of the world. On the eastern seaboard in the US, modernization has a real focus on resilience, and therefore, changing grid to respond or perform better when there are weather events. So that involves a lot of ungrounding or undergrounding or more resilience. In other parts of the world, it's more regulatory driven, as we've seen with Stadin in the US, or in Europe, or on the west coast of the US, where there's state by state there's stronger decarbonization pressures or stronger pressures to be able to install charge ports at home and things like that. So in some quite a cauldron of pressure on our operators, and they are facing inevitable pressure to change and upgrade the grids. So on the next slide, from an architecture perspective, this is a typical stack. I'm not going to walk through all of this, but I will highlight a few things. That smart grids involve a lot more software, as the previous graphic showed you. And the heart of a smart grid system are the boxes in orange here, which collectively these solutions are called advanced distribution management. And basically it means a much more automated environment and an environment that is responding to a lot of information throughout the day, a lot of sensor information that has predictive capabilities and modeling capabilities, and that is designed to be really a very flexible architecture. A smart grid, with an increased amount of alternate energy sources, in some ways is less predictable. You don't know where the sun's going to shine, or the rain's going to be, or the wind is going to blow. And so, the mix from one day to the next will change in terms of where your energy is coming from, and where it's being produced and where it's going to be consumed. So big change there in the software systems. Now, our role in all of this is both on the sort of inbound and outbound from the ADMS. So ADMS every day have to have an accurate record of the assets out in the field, and they need to know what is up and running and powered. So all of that information is contained in the geospatial system, like us. And in addition to that, the ADMS will issue a lot of instructions to field operators in terms of things they have to do during the day, and services that need restoring, or responses to outages, etc. So all of that requires strong mobile capabilities and enterprise mobile capabilities, so that the field engineering can keep the grid running out in the field, and therefore allow the ADMS to do its job. So all of that we describe as the operate cycle. And then the other cycle here is the construction cycle. So on the left, you see planning, design, power systems, and GIS. So that's a set of capabilities around designing and constructing new grids. And so here we offer design capabilities, we offer construction capabilities specific to the electric market, and that's another way we'll enable them. So in sum, on the next page, we're selling three software concepts into this market. So system of engagement to handle their plan, build, and operate life cycle. We offer enterprise mobility that replaces many disparate mobile systems that many of their existing vendors have and are not very good. And we also offer data management, so model management, allowing our customers to pull together disparate data sources and to feed them in one batch to the ADMS, so the ADMS can do its business modeling. Adaptive Grid has already been released. We released it in Q3 last year, and in fact, we already have customers using it. The whole Adaptive Grid concept was actually worked out in collaboration with some of our key customers. So this isn't just us, imagining what our customers would like, but it's based on a lot of research and a lot of collaboration with customers. So we know it works, and it's based on real world capability, real world needs, and a lot of primary research.
Okay, we've just got a couple of questions there. I think the one on gross customer retention, I'd answered the sort of retention figure. I mean, our gross ACV retention is about 118%. I'll come on to the sort of gearing question, I think, after I've talked about some of the detailed financials, which I'll go through now. So this is quite a good slide for just sort of talking about that, actually, the gearing and where some of our revenues come from. So we break our revenues down into recurring revenues and non-recurring revenues. So recurring revenues increased by 84% to £10.6 million. That was actually a slight dip in the recurring percentage, and that's mainly driven by a couple of factors. Firstly, Comsoft. So when we bought that business, it was only 25% recurring, so that's had a dilutive impact on the recurring percentage. And as we go over the next couple of years, we're looking to change their model away from a license model to more bundling in that product with our subscription and recurring revenue. So we should see that pick up again. And the second thing on recurring revenues is that obviously our services had was a slight uptick in the percentage of services in the revenue mix, and services revenues increased by 89% up to £11.5 million. Perpetual software, that always fluctuates year on year. We did £1.1 million in 2022 compared to £2 million in 2021. We've already signed, as we've announced, a £1 million license in the first quarter of 23, so expect that to pick up towards the £2 million mark again as we go through this year. And some of our customers, specifically in the the utility side in North America, tend to favour when you need a perpetual license. And then we've got demand points. This is purely through the Comsoft acquisition, and these are the annual licenses where Comsoft are selling. They don't sell on a per seat basis, they sell on a demand point, which is a home planned basis. So they're using that software for automated fiber planning, as Richard said, and there it's sold on a point that is planned, which is a home or a business. In terms of sort of how we look at the business and operational gearing point of view, well, you remember I said we had exit ARR of 15.1 million. We'll probably do slightly more perpetual software in the current year compared to 2022. So we've already signed a £1 million license. The £3.4 million comes from the 4.5 months of Comsoft. So expect under the full year to be, I think we had a very good 4.5 months, but we expect to do more on a full year basis than that 3.4 million there. And then we'd expect services to be probably slightly higher than it was in 2022. We've still got a huge amount of project work. We've got at least 6 or 7 months visibility, and we're signing new orders as we go through 23 on the service side. So we'd expect that to increase. And as I mentioned earlier, we'd expect the margins to pick up from about 20% to broadly 24-25%. So that's dropping another £1 million down onto the bottom line. So if you add all of that up, we're looking then, that's how the current broker revenue forecast is around the £33 million mark. But with the increase in the margins and recurring revenues, perpetual software and demand points have got a very high percentage gross margin, and the increase in the services margin, will all flow through to the bottom line. Yes, of course, we're going to increase some of the costs as well. But overall, that increase in the margins and in the revenues will flow through and give us our broker forecast for our profit and EBITDA. Just one question just then. Service revenue doubled to £10 million over the last year. How much of that is utility versus telco? And how did that mix vary with respect to 20 or 21 percentages? Okay, I don't have that. That's not a question I'm going to be able to answer here now. It's sort of, it's quite not something we look at on a day-to-day basis. We just measure the overall services line as a whole. I would say broadly, it's probably 70% telco and utility, given the activity that we've got going on, and that sort of swing towards telco that we mentioned earlier of 60-40. So that's my gut feel, but I don't have those figures.
Well, another way to look at that is that much of the utilities stuff we do is through partners. So in Japan, everything we do is through partners, so they do all the installation work. In Europe, our recent win with Stadin, much of that is much of the installation work there is being done by our partner CGI. So right there, that tells you that most of the services work is coming through our telco side.
Yeah. Okay. Just in terms of our cash flow, we were pleased with the operating cash flows prior to working capital of 0.9 million. We're selling most of our subscriptions and recurring revenue on an annually in advance basis, paid annually in advance. So we have a positive movement in the working capital. We're getting R&D tax credits. We've got 18 million pounds worth of tax losses across the group. So I know that varies per region, but overall we're getting tax cash back in terms of R&D tax credits. We're spending about 3.1 million pounds on the development of our products, and then the rest of the cash flow there's the tail end of the sort of the deferred payments for the acquisition of OSPI. We've got 5 million pounds being paid for Comsoft, and offset by the 3.5 million pounds we received for the fundraise. So we ended the year at 8.1 million. We're expecting to be cash generative this year, and excluding any other acquisitions, we'll end up with more cash at the end of 2023. And then just in terms of our balance sheet, obviously the intangible assets is growing. We're capitalizing about 3 million pounds worth of R&D expenditure. That's amortized over 3 years. The rest of the intangibles there is through goodwill, acquired intangibles such as customer relationships and acquired IP. And then the other aspects of the balance sheet growing as we grow the business. So trade and other receivables increasing as the business scales. And then on the trade and payables line as well, there's also deferred revenue in there, and because we're getting paid annually in advance, that's increasing. The fair value of the deferred and contingent consideration, that's 2.2 million pounds. So we're going to be paying 1.5 million euros in April, and then likely that the other part of the earn-out on Comsoft is likely to be paid in 2024, depending on how the earn-out goes at that point in time. One more question there. I think I've got. I'll come on to headcount in a minute. Do you expect much growth in capitalized development spend in the coming years? Yes, it will increase to an extent. We're sort of going to be pushing 4.5 million pounds towards 5 million pounds gross expenditure on our R&D team and all the engineers and developers. We've got 3 main development centres. So we've got Denver, Cambridge and Ghent. And we're increasing the number of developers we've got. They doubled in the year from, as you can see here on this slide, from 21 to 41. We're going to add a few more as we go throughout 2023. So that development expenditure will increase, but it will probably cease at that or tail off at that level there. In terms of our headcounts, technical consultants, those are the professional services staff carrying out the services. So they doubled in the year, and we've already shown the services revenue increasing by 89%. We're investing in sales and marketing. We've nearly doubled the number of developers we've got from 21 to 41, and then we're also beefing up the admin and back office sides of the business as well to scale for the growth. And you can see there the sort of the geographies we're adding across all disciplines and all geographies as well. We hired 31 net new heads in 2022. We're likely to see around somewhere between 30 and 33 new hires in 23 as well. And there's just something on our ESG and sort of carbon neutral status. We've decided as a company that we want to be carbon neutral, so we are tracking that year on year. And although the absolute number has increased as we've increased heads in 2022. We're still below the benchmark level per employee of carbon emissions that we benchmarked against in 2019. Obviously, there was much less travel in 2020 and 2021. We're starting to see some normality return in terms of flying, but we're trying to measure that and restrict it where possible. And then just the employee net promoter score, we measure that annually. We've gone up from 37% in 2021 to 42.5% in 2022. We think that's a really good result. Anything over 40 is seen as excellent, and we compare very well with other benchmark tech companies and other companies in general. So something we're very keen to keep measuring, and we're very proud of. I think that's it in terms of the presentation. There's one more question there. Are the major incumbents planning to build a solution to compete with you?
Yeah, let me take a stab at that. The answer, well, never say never, but right now not. And there's an important reason for that. We are specific to 2 verticals. So all we do is telco and utilities, whereas most of our competition, so Esri, GE, Schneider, Esri and GE in particular, they are multi-market. So for a company like Esri, they make a lot of their revenue from education, from government, military, research, science research, agriculture, and things like that. And these are very large companies. But the fact is that we are able to compete against them in these verticals because there is a lot of knowledge required to produce a system that is viable for network operators. The ability to model a grid accurately and to create a true digital twin is complicated. And it's an area where we can build enough competencies and barriers to entry, if you will, for other operators, that the cost benefit analysis just doesn't work. So for now, we've been able to defend our market share very well, and in fact take it away from some of the incumbents, and that's worked for us. The other important fact about the incumbents is that being generic, they tend to rely much more on an ecosystem, on partnerships. So they have a lot of smaller companies or partners that provide capabilities in these verticals. And so making a big investment into coming after this space would create friction with a lot of these partners. So they're kind of stuck with a model they settled on a few years back. And I think the problem they're having is that this partnership model is not delivering very effective solutions. And at the same time, if they try and correct that, they're displacing customers. So there's a bit of a catch-22 that they have to face. Obviously, we're alert to investments they make, but we feel that we have quite a number of years advantage over our incumbent partners. The most important one being that our architecture is of a different generation. So I mentioned earlier we're cloud native and mobile first, and it's an incredible amount of work to move a solution from being a client architecture to being a cloud native solution. And again, these are very significant investments, and most importantly, these are no longer upgrades. If they decided to do this, they would be trying to convert a customer base or forklift a customer from one product range to another. Again, very, very large and risky projects that I don't think are worth the investment. So incumbents, we watch them carefully, but for now they're sticking to what they've been doing in the past, which is incremental upgrades and being generic geospatial providers. We do see smaller companies trying to follow in the path that we've created. So locally, in Europe, we've seen some smaller companies come up with visions that are close and similar to ours, but they don't have the distribution capabilities. They don't have the sales and marketing capabilities. So they tend to remain quite confined to single markets and sell on price. And they frequently don't have the quality of the references that we have. So what that means is that when we are competing for a large piece of business, we have the references and we have the architecture on our side, and price frequently isn't what matters here at all, given the kind of investments they make. So that's
answer that question on the acquisition side.
Yeah, go for it. Yeah, go for it.
So the question is, are you actively looking to make further acquisitions, or do you make these on an opportunistic basis? I.e., are you a roll-up or just focused on organic growth? Well, to be honest, we're focused on both. Primarily, it's organic growth. I think we've done we've shown we've done a good job on that, but we can also gain through acquisitions. And it's not, I wouldn't say it's opportunistic. We're actively looking in the market, but it has to be the right product. It has to bring something, it has to have the right revenue profile, bit of recurring revenue. It has to fit in with the two main verticals of telco and utility that we already focus on. And because of our, the network life cycle, there are lots of companies who compete in sort of the different verticals that we might not develop, but we could add on. So we do actively look, but it would have to be the right opportunity for us to acquire. So hopefully that answers that question.
I would add that we're not we don't require acquisitions to continue our growth trend. We see a lot of growth in the customer base we have and with the product range we have. But where something is complementary and where it can accelerate or facilitate that journey, then we'll definitely look at it. But plan A is to grow what we have.
Richard, Hayward, thank you very much for that. I think you actually managed to address every question from the investors today. And of course, the company will review all questions submitted and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both and the company, Richard, could I just ask you for a few closing comments?
Yeah. Well, first of all, thank you very much for all your warm messages and the questions today. It makes it interesting for us, and we appreciate the thanks you're giving us. Yeah, we're enjoying what we're doing. We see a lot of roadmap, a lot of road ahead of us. We think as a company we're in the right place at the right time. The product's in good shape, staff are happy. So we feel this is a really good period for us, and we see future growth. So for all of our current investors, thank you for sticking with us. We hope you're getting returns you like, and for those of you considering joining us, look forward to having you on board our share register.
Richard, Hayward, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of IQGEO Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you very much.